Hi, my name is Jason Winter. I am a staff accountant at Brewer Inc. Today we are going to talk about the tax implications for the dividend received from TKS Inc. We will also discuss how taxes affect other business types. Since Brewer is a C corporation, we were allowed to take advantage of the dividends received deduction. This deduction was received to minimize the effects of double taxation, and certain rules apply. For starters, a company has to be a C corporation, it has to be an American company, and a taxable entity. Our company complies with all these rules. Some additional rules apply as well. Depending on how much ownership a company has of another company can affect the amount eligible for deduction. For example, if a company owns less than 20% of the company paying the dividend, then the company receiving the dividend can deduct 70% of the dividend. If ownership is 20% to less than 80%, the deductible is 80%, and ownership over 80% allows for 100% deduction of the dividend. Since Brewer owns 16% of TKS, we were able to deduct 70% from the dividend received. This minimized our rate of double taxation. As a smaller corporation, we may have the option to convert our business structure to some other business structure. Our options for conversion are a sole proprietorship, partnership, or S corporation. Unlike C corporations, each of these business structures is pass-through entities. This is important. This means that the owners are directly taxed on their individual tax returns. A sole proprietorship is a business entity that is allowed and run by one person and in which there is no legal distinction between the owner and the business. If we chose to convert to a sole proprietorship, we would have to designate one of our stockholders to become owner. Dividends are taxed like normal income. A partnership is similar to a sole proprietorship. The difference is that there is more than one owner. Taxes are paid like normal income. An S corporation is a corporation that meets specific Internal Revenue Code requirements. Giving a corporation with 100 shareholders or less the benefit of incorporation while being taxed as a partnership. This business form has the advantages of a corporation and tax advantages of a partnership. Again, dividends are taxed like normal income. Unlike a C corporation, an S corporation is not double taxed for dividends. There are different requirements for the transition from a corporation to a different business type. We'll take a look at what that would be, or what would be involved with that now. Reorganization from a corporation to a sole proprietorship requires a great deal of organization and research. The tax implications would be difficult to compute, but chances are that the sole proprietorship would end up being personally liable for taxes during the transition. There is also the chance of double taxation during the process of stock transfer to personal property. The corporation must have total written approval to make the change, and each state has different rules. In addition, creditors must be fully aware of your intentions as well. A transition to a partnership is pretty much identical to a transition to a sole proprietorship. The only advantage is that taxes from the transition could be split between the partners. Reorganizing into an S corporation will be relatively simple, as long as certain restrictions are met. First, incorporation must have been completed within the U.S. There cannot be more than 100 shareholders, and the shareholders must be U.S. citizens. The corporation can only have one class of stock, and written consent must be given by all shareholders. If Brewer Inc. chooses to convert to a different business structure, it is recommended by this accounting group that the most logical choice would be conversion to an S corporation. The transition would be relatively simple compared to other business structure transitions, and the tax advantages would be the same.